Just when you thought things could not get worse, we get another heavy red day right across the board, coming off from last week, which was the worst performance in the S&P since September 2024, and we can see investors are clearly worried about the shorter term. We have now entered in at the 16 extreme fear point. Just on Friday, it was sitting at 20, so worries are continuing to pile up. And just last month, the Bank of America warned the S&P could crumble down 40%, saying that right now we are sitting in a bubble era. And if we look at the last week, in fact, the performances don't look any better. Many companies, many sectors all down in the red. And if we extend to over the last month, we can see the continuation. We have the majority of the Mag 7, other than Apple and Microsoft, all down double digits just in the last 30 days. And you can clearly see that people are getting frustrated with President Trump, calling him an agent of chaos and confusion, and now a recession could be on the cards. We have CNN saying the US stocks drop after Trump says he won't rule out a recession. We have the New York Times saying stocks extend declines as recession fears ramp up. We have investors fearing that a tit for tat on tariffs could in fact start a global trade war, creating price rises, slowing down growth, and a lot of uncertainty, making it to the detriment of the consumers. We also have Bloomberg, who have chipped in saying slumping stocks point to mounting recession fears, and with all of the drops, we can see the S&P trading at a P ratio of just under 29. Now bear in mind, you may think that isn't high, or maybe you think that is fairly high, but when we take a look at both the mean as well as the median, we can in fact see they do sit around the 15 to 16 mark, so you shouldn't be surprised if there is a lot more downside to be had, but again, no one can time the market. And then when we take a look at companies in terms of a forward P valuation, many of them in the red, even with the drops we have seen, the double digits. We have Microsoft trading at a valuation of 25, Apple 27, Amazon 25, Tesla 60, as well as others across the board which are trading above their own 5-year averages. However, one thing is for certain, no one can predict the future. Now just last week, the very popular CNBC analyst Tom Lee said he is a buyer of stocks. He believes that bad news has already been priced into the wider market and is fairly optimistic, and he even goes on to say that it's very possible that in March, April and May we do get a massive rally, and he estimates this to be around 10 to 15% and calls this essentially now a bear market in terms of sentiment. Again, as we can see here, he does say he is optimistic, and he says he can understand why investors are sitting on their hands. They don't know how severe these tariffs will be, how long they will go on for, but right now a massive price correction and a decline in sentiment is reason to be bullish. And again, this trade war continuation isn't helping the market that does like to see certainty, with in fact Canada tariffs staying until the US shows them respect. And those are the words from the new Canadian Prime Minister, who says they vow to fight the US trade war until Trump shows respect, and he believes that President Trump in fact is destroying the Canadian way of life. We also on the other hand have China, who are hitting out at US farm goods, again escalating on these tariffs, which one thing is known for certain, the person who will not benefit from this are the consumers. Now what is the best strategy when we are getting a market correction? We're seeing a lot of red across the board. We are told never to time the market as no one has a crystal ball, and one strategy is just a purely dollar cost average, and this is something that the New York Times has discussed. They've gone through the different strategies, and they ultimately believe, regardless of whether there is a down market, an up market, high volatility or low volatility, the majority of the time you are better placed to dollar cost average in rather than waiting for a particular moment in time, again because no one knows where the markets are headed. We also get the thought here of what about if it is better just to sit on cash, wait until the markets do cool off, or in fact maybe we should just put in whatever money we have in right now because tomorrow we could see an incredibly large rebound. And Vanguard, like New York Times, have done their own strategy, and they say here that LS, referring to lump sum, mostly outperforms cost averaging. That is essentially investing a certain amount at a certain point in time on a continuous basis, but the cost averaging still largely beats cash. In fact, when we do look at the percentages, lump sum outperforms cost averaging 68% of the time, and cost averaging versus cash does outperform again 69%, with lump sum outperforming cash 70% of the time. So what we would say with this strategy, it is better to 1, stay invested in the market, and 2, either dollar cost averaging or lump sum average. And then when we take a look at what is best for risk adverse investors, we can see a cost averaging strategy is superior to remaining entirely in cash, and if implemented properly, may be more suitable for those that are risk averse, those that don't want to take on a significant amount of risk over a significant period of time. But given the cost of holding cash for extended periods, most investors, particularly those that don't have a significant aversion to loss, should invest a lump sum immediately. As always, different strategies, investors will want to do what they believe to be best, but if we really zoom out and look at the market from 1870, there have been significant times where you would have been scared of moving your money out of the market. We have quite a lot in just the most recent period. We had the COVID pandemic, we had Ukraine, we had inflation, we had Black Monday, as well as the Great Recession, and many others even before then. But ultimately, what this is trying to tell you is that you are always better off staying invested in the market if you are someone that is a longer term investor. Now, having said all of that, we do want to also consider whether there may be opportunities in the market right now. So looking at just some stocks very quickly, what we believe in terms of our own fair price, we can run through them, starting off with Nvidia, which now sits at $107. Over the last year, they're up only now 15%, with year to date being down 20%. That is typically what we would call a crash, a very significant amount. In fact, the technical definition of a correction would be around 10%, and a crash sitting at 20% does sound to be fair. Yet over the last 10 years, this company has massively outperformed, up 18,000%, right now trading in the lower end of the 52-week range, with Wall Street who do believe this company is now a strong buy, as well as seeking alpha. It also trades at a forward PE sitting somewhere around the 25 mark. And just two things before we tell you our own valuation, we just want to give you confirmation against their own 5-year, they are valued significantly lower, and we can also see, based on this method, comparing it against their 5-year average PE, in terms of the blue tunnel, the expected fair price, that has been increasing over time, something we would expect with companies we want to invest in. But right now, there is massive disparity among where this company sits and the lower end of the blue tunnel. Again, that is a severe undervaluation signal. Now, very briefly, we'll show you our valuation for this amongst the others that we cover. We get to $162 derived from the DCF model. We'll run through this, and then the rest we will just show you that we essentially get a growth rate of 20% moving forwards. As you can see, 5 years they've been growing at triple digits, and over the last 10 years at 104% year on year. We do also have a low, medium, and high, 15, 20, 25. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others. But based on the growth rate and the discount rate, we then get the present value of future free cash flow and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 162, indicating 52% upside. Now, we'll also show you, for those that believe that is too high, at the 15%, $115, 8% upside, and for those that are a lot more optimistic, at the 25% point, $227, 112% upside, more than a double from the current value. And we're not just done, because we do like to take through the median rate typically on the channel, where we then do apply a margin of safety. 10%, we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy at 146, and then effectively we keep going till it's near the current trading price. And what we're saying in today's episode, around the $106 mark, where this company sits right now, you're getting a 35% margin of safety for Nvidia, whilst Wall Street and their strong buy, they see this at $177 over the next year, translating to 66%. Now, bear in mind, that is a growth rate moving forwards of 20%. If we were to use the lower rate of 15, we would still get a very small margin of safety, and that would sit around the 5% point, up to around $109. Again, let us know if you are picking up any of these stocks that we're running through today, or in fact, any others. We also want to let you know we have just released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks, as well as what's going on in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to undervalued stocks for the month of March, lots of information, as well as the upside that Wall Street themselves see over the next year. And you can grab a recently released copy of 32 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Another company we've discussed on this channel that looks incredibly like a very strong buy right now is Alphabet, up 23% over the last year, hammered down 13% year to date, but over the last 10 years, they have again outperformed the S&P, up 496%, trading in the mid to lower end of the 52-week range with a double buy from seeking alpha in Wall Street, and we can also see their forward PE sitting around the 19 mark. Now, if we were to compare that against their 5-year average, it does sit lower versus 22.3. Again, another severe potential undervaluation signal. And if we were to look at it at this historical model, we can again see it does sit outside of even the lower end, indicating that continuation of a severe signal. If we were then to show you our intrinsic value, we get to $226, with Wall Street themselves seeing $220 over the next year, translating to 33% upside. And as you can see, we have gone for 12% in terms of the growth rate, with the low, medium, and high signaling here different upside. So with the 12%, when running it through the MOS calculation, we will in fact in today's episode get quite a significant figure. Not 30% just yet, but you are looking at least up to $170 at 25% MOS. For those that do believe we should use the lower rate, well, we can again show you at 10% growth to the free cash flow moving forwards, you would still get quite a substantial margin of safety sitting around the 15% mark. Again, we do believe this, like Nvidia, is one for consideration for the portfolio. We then move to another Mag 7 that has been hammered today, down nearly 6%. We see over the last 12 months up 15%, year to date pretty much flat, one of the best performing in the Mag 7 in 2025, and over the last 10 years, massive outperformance, up 605%, trading now in the midpoint of the 52-week range. Another strong buy from Wall Street and a buy signal from seeking alpha, with a forward PE sitting in the 24 to 25 region. If we were to take a look, unlike the previous two, this one actually trades pretty much in line with their 5-year average, and if we were to run it through the same process, we can in fact see right now it is sitting in the middle. So both of these signals telling us right now that Meta does look in a reasonable movement, but as always, we never look at those models in isolation, and we do get to $700 in today's intrinsic value, where again you can see we've actually gone for the lower rate for Meta at 10%, giving us still a nice MOS even at that rate. And as we keep going today, you can in fact see you are getting at least 15% up to $595, with Wall Street themselves seeing this at 765 over the next year. With their strong buy rating, that translates to 29% upside. A company we haven't covered in a long time just due to the fact it hasn't been at that nice undervaluation point. Booking Holdings down 5% just today, over the last year up 28%, and year to date down 10%. Over the last 10 years, massive outperformance of the S&P, up 285%, trading in the midpoint of the 52-week range, a double buy from seeking alpha on Wall Street, and this one trades at a reasonable valuation at 22 on a forward basis. We can also note it does sit below the 5-year at 23, so a possible undervaluation signal, and if we were to look at it in this model, we can in fact see it is sitting right at the lower end, again another possible undervaluation signal. If we were to take a look at our intrinsic value today, it comes at just above $5,000, and when we do dissect it, we have gone for a 4% growth rate moving forwards. One you could argue is a little bit more on the conservative side, and then when we do take it through the margin of safety, for Booking Holdings right now, we see it 10%. For some people, that just isn't sufficient. They want a bit more, which is something we would agree on. We do believe 10% right now is just a little bit too low. At 15%, a buy at $4,256, and at 20%, around $4,000. So Booking Holdings, 10% MOS, definitely one for the watch list, and we see Wall Street still bullish, price target $5,623, translating to 26% upside. As always though, we do want to hear your thoughts below. We then move on to S&P Global, down nearly 2% today, up 15% over the last year. Year to date, down 2%, but again, like the majority today, massive outperformance of the S&P, up 369%, trading in the midpoint of the 52-week range, with a strong buy rating from Wall Street and a buy from seeking alpha, trading at a fairly high valuation in comparison to others so far at 28.9. If we do take a look, however, it is sitting below what it does normally trade at over the last 5 years at 30.2, and if we were to run it through this model, we can in fact see it trading right towards the lower end of its fair price. Again, these are all potential undervaluation signals. Now, if we take a look at S&P Global, our valuation valuation, one we did a deep dive not too long ago at $634, is derived from a 12% growth rate moving forwards, where when we do get to the margin of safety, again one that could be there for consideration in the portfolio, doesn't come to 25% just yet, sitting at 20% up to $507, with Wall Street seeing 24% upside, their price target $610. Again, we can show you for the low rate whether or not there will be a margin of safety at 10% moving forwards. So when we do input the 10%, you're pretty much getting that right now if you see the growth at the lower end, with Wall Street's price target remaining untouched at 610. We then have 5 other stocks that we're just going to do a very high level at, and the first one is Uber, which is down 9%, in fact down 5% today, and over the last 5 years this is up 151%. That has outperformed the S&P. In terms of where it sits at the midpoint of the 52-week range, we get a strong buy from Quant, a buy from Wall Street, although that is very near the 4.5 to flip that into a strong buy, and a buy from Seeking Alpha, trading at a forward valuation of 31.3. And when we do get into the valuation of Uber, we see this intrinsically at $104. You can see we've gone for a growth rate at 10%, and thereby does give us quite a nice margin of safety. In fact, as we keep going, you can see that in today's episode, you're getting 30%. Wall Street themselves, very bullish, $92, translating to 26%, but we can again show you at the lower rate, even of 8% moving forwards, you are still getting a margin of safety. So if we were to look at the 20%, pretty much where we see this now, and Wall Street untouched at 26%, again, we do believe this one should be there for strong consideration in the overall portfolio. We then move to Amazon, one we did a deep dive just today, so if you want more behind our thoughts, do check that out. A double strong buy from Wall Street and Quant, a buy from Seeking Alpha, trading at a forward P around 31, up 12% over the last year. Year to date, down 12%, but over the last 10 years, massive outperformance of the S&P, up 916%. And when we take a look at the valuation, we get to $230. That is derived from our lower rate of 20% to the free cash flows. And what we do in turn see is a nice margin of safety for a very high quality Mag 7, not at 20% just yet. You are sitting at least 15% up to 195, with Wall Street now their upside only getting higher as the share price decreases. They see this at $270 over the next year, translating to 40%. We then have Arista Networks down 8% today, trading essentially at 14% up over the last year. Year to date though, hammered down 30%. Over the last 10 years though, massive outperformance of the S&P, up 1,616%, trading towards the lower end of the 52-week range, triple buy rating all across the board, with a forward P sitting around 33. If we then take you through our valuation, we get to $162. That is derived on the average of these two models. In fact, we'll show you the DCF element where moving forward, we have gone for a growth rate of 0%, which you could argue to be on the more conservative side. And there in turn, we do see a very large margin of safety. But as always, investors will want a certain amount before considering in their portfolio. We see at least 50% around the $80 mark, with Wall Street seeing this at $125 over the next year, translating to 62% upside. Now we just want to talk about Tesla because this one has been battered down 14% just today. Year to date, down nearly 50%. It's actually 44, but nearly lost half of their market cap just in 2025, with only 2 full months that have gone. Over the last 10 years, however, massive outperformance, up 1,703%, yet we still have all 3 analysts calling this company a hold, trading towards the lower end of the 52-week range, and still quite a severely high forward P of 92. Now, last time we reviewed this company, we got to an intrinsic value of $203, and back then it was trading significantly higher. Even with our intrinsic value of $202, that is at a growth rate of 35% moving forwards, which if you don't buy too much into the robotics and the autonomous driving in the shorter term, you could argue it could be even lower. So right now for Tesla, for those that are wondering, we do see this at the bare minimum a fair price around $200, although we have Wall Street who are very bullish, seeing this at $350, 54% upside, but as always, give us your thoughts below. Finally, we wanted to include Netflix, which is down 4% today, up 43% over the last year, but year to date it is down 4%. High quality company that just hasn't been at the undervalued stage yet, up 1,300% over the last 10 years. now trading near the midpoint of the 52-week range, a strong buy from quant, a double buy from Seeking Alpha on Wall Street with a forward P of 35.8. Now our valuation comes to $725, and that is using a growth rate moving forwards of 15%. One you could argue is too high, or maybe you see this as a little bit too low, but ultimately this is where we have it today, and therefore there is no margin of safety. For us to consider this, we would like a 10% MOS, so if it does in turn come down to around $652, we would say this could be considered as a buy. At the moment though, trading at a premium, yet Wall Street do see this at 28% upside over the next year, just over $1,100. As always, give us your thoughts in the comments below, whether you agree, whether you disagree, and what is your strategy moving forwards. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.